I read a stat online recently that said 1 in 5 to 1 in 7 companies actually reach that Series A mark from the seed round. I always ask each one of my founders, what makes you the best person in the world to do this and to solve this problem?
Hey, John. Thank you for taking the time to do this fireside chat as the founding partner of a VC that's joining us from San Francisco. We'll be taking this time to learn about your decade investing across AI, enterprise software, SaaS, and fintech. And we'll be learning more about what today's founder and investor attention is concentrating today, what areas are becoming crowded, and how investors are thinking about defensibility as the AI landscape continues to evolve. So, John, could you introduce yourself?
Yeah, hey, I'm John. I was a former Berkeley alum as well. I graduated in 2011 with dual degrees in computer science and business. So excited to speak to everyone here. Since then, I've been an entrepreneur. I worked as a consultant. I've led product and engineering. And for the last 10 years, I've been an angel investor and in venture capital, spending much of my time at two firms, one Trinity Ventures and the second F Prime, which is Fidelity's investment arm. Currently, I have started my own firm called Linea Ventures, focused on investing in AI infrastructure and AI applications. And that was started earlier this year.
Amazing. And John, could you share when you look at the world today of investing, let's get to it. What's exciting? What's hot? What's scary?
Yeah, if we back up a little bit, investing has changed a lot in the last 30 to 40 years. One thing that people don't realize is that venture capital is a relatively new industry. In the 1970s was when the first venture capitalists really got started, maybe 1960s. And since then, it's gone through a really big evolution, first with the internet bubble, then with the mobile wave and SaaS startups, and now with the AI wave as well. Along that time, the financial vehicle has also shifted a lot and the way venture capital is done. Maybe about 20 years ago, there were only a handful of companies in Silicon Valley that were doing investing. And now there's thousands of venture capital firms, and much of the money is shifted not only towards the early stage, where there's a lot of seed stage small firms now, as well as there's now this pre-IPO market, which is becoming really hot lately. So in the last 4 to 5 years, more and more money is shifted towards that space. And today, companies that are worth over $1 billion make up about 2/3, if not more, of the funding rounds these days. So it's quite a shift in the venture capital environment.
Yeah. So that's a big shift on the venture capital investing side. And also, there's a lot of buzz around investing in AI in Silicon Valley. People think about it as the biggest technology wave. What do you think about AI? Is it huge? Is it overhyped? How do you think about it? Yeah.
Oh, I think it's going to be one of the biggest shifts in our generation. There's a bunch of factors that I think about with AI, but one thing that I want to put in people's minds is this is almost like the Industrial Revolution in the 1800s. In the 1800s, there were some different types of vehicles. We used horses, we had plows, we had some basic railways, etc. And if you think about how much mechanical work was done at that time, you could say that maybe 40% of the work was done by machines and 60% was done by humans. We're in a similar time frame now for knowledge work, where yes, there are a lot of knowledge work things that are currently being done by humans, and there's some that are being done by machines, and we have great computers right now. But over the next 10, 15 years, I think that number will very quickly go from 60% of work is done by humans to close to 80, if not 90% are done by computers. So it's a really big shift. And one thing that I like to point out in particular is over the last 2 or 3 years, and especially this year, there's been one major shift, which is people are now using AI to do coding. And that's effectively enabled coders to be 5, 10 times more effective than they ever were. Now, there's a lot of AI slop and bad code out there, and we could talk about that. But generally, if you're a really good coder, you can be 10 times faster than you were before. So if you think about that and think about how that affects technology, that means technology is being developed 10 times faster. So within the next year, you can expect as much innovation as the previous 10 years. And within the next 3 years, you can expect as much as the previous 30 years if the only restriction was coding. Now, obviously, there's other restrictions and things like that. You have to get things into market, there's hardware development, et cetera, et cetera. But I do think that within the next 3 to 5 years, we're probably going to see more innovation than we have in the last 15. So it is quite an interesting time for AI. There's clearly a lot of hype, and we have to be careful about what we invest in and how we use AI. But I think this is probably the biggest shift of our generation and of our careers. If you're 20, 30, in your 20s, 30s, or 40s, like this is going to be the biggest shift in your career. So,
Okay, so there's a few ways to approach this question, but I guess the first question is, if this is the biggest shift, what's the play for folks that people should be thinking about? Would it be investing? Would it be joining an AI company? Would it be using those tools? How do you think about that right now?
yeah, I think all the above. So, if you are not using AI right now, you should consider learning it. I think like if you don't, you're going to be at a disadvantage to everyone else. And I think that some people, especially kids who are in college right now or in high school, are over reliant on AI. But it's important to know both the limitations and be able to experiment with the right ways to use AI. So all of it, in all honesty.
And when you think about investing, obviously there are different ways to invest. What's your approach right now, John, to investing? Yeah.
So personally, I have a lot of angel investments. I obviously have my own fund, and then I keep a portion of my capital in the public markets as well. So that's where I encourage people to invest. I think, quite frankly, the S&P 500 or the total stock market is heavily weighted towards tech companies already. So just by being in those, you naturally get exposure to some of those areas.
And this is where I'm going to start asking questions on behalf of the people who have already asked questions beforehand. One question that people asked was, there's clearly a huge amount of capital flowing to AI, but ultimately the value has to come from somewhere. Where do you think the economic value of AI will accrue over the next 5 to 10 years? And what part of the current AI investment cycle do you think is being overhyped?
I think it's going to accrue at a lot of areas, is the short answer. If you think about today's work, currently almost half of the workforce is doing some type of knowledge work. So I think within that half of the workforce, a large portion of it will be augmented using AI over the next 10, 25 years. I do want to say this is really important, but I can also say you could have said the same thing 150 years ago during the Industrial Revolution, and people found other jobs. There was clearly a lot of job displacement. One interesting anecdote is that the most popular job back then was a whaler. So killing whales and then using their fat largely for fuel. And that clearly got replaced. There was some job replacement. But today you have more jobs than ever in many of the industries that we couldn't imagine 150 years ago. So a lot of those jobs will be augmented. Now, in terms of like where the value is, I think you have to look both across AI infrastructure and AI applications. Across the infrastructure side, there's this whole paradigm of like, how do we build models for each individual company? And to do that, you have to have many layers. So you have to have a data layer where you're gathering unique data. You have to have an orchestration layer where you're doing things like training models, doing post-training, doing data cleansing, deploying the models. And you also have to have hardware to run this, whether that be GPUs, whether that be specially configured chips for inference or for training. So I think there's going to be areas there in all those areas where there's going to be immense value creation. There's also a bunch of tangential areas, like power is going to be really important. And so is hardware, whether that be in cars or robotics. And then that's on the AI infrastructure side. On the application side, I largely think there's going to be value accrued in basically three areas. The first area is companies that can be great data providers and provide unique sets of data such that the models can do more and more training. The second unique area that I think is really interesting is companies like a Harvey, for example, where they are traditionally a vertical AI play, but they're now creating their own models. And by doing so, they're effectively creating their own version of an LLM or version of a model that's specific for legal. And I think that will be the case for every industry out there. And then the last way to create a lot of value using AI is to look for areas that you couldn't traditionally do business before because it was too small a business, because there was too much manual work, et cetera, and replace that with AI or have AI augmented such that it's a viable new industry.
And which parts of it do you think is overhyped right now, if any?
Yeah, it's a good question because it's like the internet bubble in the 2000s. In one sense, I think everything is overhyped, and so you have to be very careful. In another sense, I think everything is undervalued because I think people are not considering the true potential value in the long term of AI. So I think it's really a mixture of both. You do have to be very careful. I think what's the toughest thing about AI and the pace of which things are changing these days is that companies are developing and changing so fast that there's not as much defensibility as there once was. You could say if you look at some of the companies even 5, 10 years ago, they spent millions, if not billions of dollars developing models. And now you can develop a model, and you can see this in a lot of the, for example, the open source or the open weight players. They're developing models for hundreds of millions, if not tens of millions of dollars. So a lot of what we used to do basically is not as defensible as it used to be in the SaaS era or back when there were an internet and there was marketplaces. So I think you have to be really careful about where you invest and make sure that you're constantly innovating. There's some level of customer lock-in or data generation such that you can create these long-term moats.
So, could you share a little bit more about how you think about investing then? How do you choose which types to do? Because you said everything's overhyped, but also they're, undervalued. So I think the question from the audience members are how do you choose which AI companies to invest in?
Yeah. So generally, I start with a few different thoughts and frameworks when I look at a deal. So the first thing I think about is there a large enough market? And how large will this market be in the future? And generally, in today's world, you want at least $1 billion market, and you want a valuation where the company can 25x. So that's really an important starting point. Then I look for great founders doing really unique things. So I always ask each one of my founders, what makes you the best person in the world to do this and to solve this problem? Sometimes it's that they happen to have solved this problem while they were working at another company. Sometimes it's they have worked on a PhD thesis in this particular area. And sometimes it's they have two unique pieces of background that seemingly have nothing to do with each other, but when you combine the two, it creates like a really interesting company. So that's the second part that I look for. The third part I look for is I invest mainly at the what I'll call the inflection point. So when companies are between 1 and 10 million in revenue. So I look for companies that are able to get there quickly and efficiently with good metrics. but they also have a very good idea of how to scale the business. So that means they have a very clear ideal customer profile, meaning if I was to find 5 people with that profile, you should probably be able to sell 2 of them and close 2 of them. You have to have a really good idea of how to scale that channel to get those customers. And I think that's really important. And then, of course, for every single industry, I think it's like very important to have unique things, traits, skills within each different area. So maybe I can give you an example if that's helpful. Last year, I invested in a company they were a tax compliance company that helps you file sales tax. So imagine that you're in the US and you own an e-commerce company and you sell on Amazon and you have a Stripe account and you probably have an in-store account and you also sell on Walmart and a bunch of other channels. At the end of every quarter, you have to manually gather all that information on each different platform. You have to figure out how much you sold in each state, and then you have to register and file for taxes for each state on each portal of each state. Some of the portals are mail-in, some of the portals are online, some of the portals you actually need to call someone. And so it's a giant headache. And so what this company does is it helps you file those taxes using a variety of AI to do calling, mailing, scraping online. It sums up all this data for you and it allows you to file the taxes. Now, you may ask, okay, like what research or how did you figure out whether you wanted to invest in this company? The first thing we do is we generally have a thesis in every area. So in this case, we spent a bunch of time on fintech and we identified that tax is an area that we're really interested in funding. And then we go and explore many of the different companies in the tax space until we believe we have a particular area within tax that we're really interested in. In this case, it was finding a unique customer, which was an e-commerce customer that we knew if they met X and Y criteria, we could sell them. Secondly, we wanted to make sure the team was world class. So in this case, the founder ran an e-commerce company. He actually ran several e-commerce companies before. And it's really rare for an entrepreneur to both be a great entrepreneur and have previously run like a dropshipping and e-commerce business that scaled significantly. So that was also unique. We also knew several of their customers. So we called up each of their customers and we asked them, why did you do this? Why did you choose this product? Why did you buy this particular solution versus doing it yourself, versus getting an accountant, versus trying to file through Amazon's platform, for example? And we got really good answers for each of those. So it's the combination of all those things mixed with great retention metrics, great revenue metrics, great cost of acquisition that gave us high confidence to invest in that company.
Fantastic. And one question that people said is, what are some telltale signs that investing your time and not money in this AI startup is a bad idea? I guess this person is a founder and saying, hey, should I either advise or build this AI company? Bad ideas. Yeah.
It's a good question. Okay, so like, just so I understand the problem correctly, this person is a founder and he wants to explore a bunch of AI ideas and he wants to know how to quickly like validate whether this is a good or a bad idea to get started on.
Yeah, I think that applies to founding executives and potential joiners of a startup.
Yeah, I think it's a little different for each of those different personas. But if I was talking from the founder persona, one thing that I really like founders to do is talk to a lot of potential customers. So that's the first thing that I would encourage customers. If I meet a founder and they have not talked to somewhere between 25 to 100 potential customers at a minimum and gotten a large portion to be interested in the product and gotten some companies to agree to buy the product once it's built, I think that is a bit of a red flag. So that's the first thing I would do. The second thing is now with Claude Code, it's relatively easy to build a simple prototype. I used to suggest building a mock-up, but now you can effectively build a very easy prototype and test it within your potential customers and see whether this is an interesting area for you to invest in. So I think those are two ways as a founder to quickly spend some time and validate whether this idea is worth exploring. Obviously, that's the first step. Then there's a second and a third and a fourth step, whether that be figuring out how much it costs to acquire a customer, whether it is figuring out whether someone besides the CEO can go sell that product, look at what other companies are in the market and what replacement products are. There's a lot of different things to think about, but that would be the first step that I would start with a problem.
Great. 1.1 billion seed rounds seem to be, the story of AI funded startups, right? Is it a new norm? How do you evaluate founders who normally just raise a normal seed round like $1 million or a couple $1 million?
Yeah. I don't fund most of the companies I fund are not the ones that start with a $1.1 billion seed round. Some of my past founders have started companies that big, but that's a very different type of company. For the majority of those types of companies, they tend to be labs that are developing foundational models, and that requires long lead times, a very strong team that is probably getting paid millions of dollars at a different company. So you need money to recruit the team. You need a lot of compute to do your training. You probably require some money to buy the data. And so when you look at those types of companies, that's almost like a completely different play than traditional venture capital. And it's not an area that I personally focus on, but clearly some of the labs have done extremely well. And you can see that if you could potentially have a trillion-dollar outcome like Anthropic, like OpenAI, I can see why some of the top venture capital folks would be funding some of those plays. But the play really there is you kind of need to be $100 billion company in order to justify making those investments. So if you're talking about a normal founder who wants to go and raise $1 billion, it's actually quite difficult. You need to be one of the top AI researchers or AI founders in the space in order to go and raise such a great round.
So another question from the investing side is, how is AI being used in investing? For example, public equities, scenario modeling, DCF modeling, management quality analysis. So that's the question they have.
Yeah, so I would say one, this is not my area of expertise. I don't trade stocks on a day-to-day basis, but I talk to a lot of stock traders, and I think there's several ways that it's being used that I've heard more of. The first thing is discovery. So looking for deal ideas, understanding different areas. So a lot of people are doing initial discovery then. Maybe they have a very broad thesis. I want to invest in companies where there's a specific EBITDA in this specific sector, and Claude or ChatGPT can very quickly get all that data for you. So that would be the first area, discovery. The second would be research. So helping to augment and look through the internet for different types of information has been relatively helpful there as well. And then the third would be like this scenario planning and analysis. So maybe they have a particular thesis that they want to backdate or test against. They can very quickly test against those models as well. So that's one area where I would say more equity, probably like mutual fund, hedge fund folks are looking. There's also a second area, which is like there's just a lot more thesis being like electronically traded now, and you could basically test theses on a very small scale. You can add more and more to the model. And so a lot of companies are also approaching that. I think one of the best companies, obviously, to ever do that is Renaissance. So they have great returns. They have their own proprietary models. That's an example of the other approach, which is let's program against some theses, let's test them, and let's quickly decide whether we want to add more money into it.
And from today's perspective, What are some of the barriers today in founding a venture? Why should people do startups?
So what are some barriers in founding it? When you say a venture, you mean particularly like a venture capital backed startup, I'm
Yeah.
guessing. So I actually think there's quite a few barriers. One of the things that we consistently hear is that in today's world, it's really a tale of two cities. So on the one hand, there's a ton of people who are getting funding, like you mentioned, some at $1 billion for a seed round, and it seems like money is being thrown at every which way to some of these top AI researchers and some top CEOs. On the other hand, it's actually quite difficult to receive funding if you don't have an idea that people think is a big market. If you don't have the background, less money is being put in early stage venture capital today than a few years ago. And even though technically there is more money in venture capital, the majority of that money is going towards the later stage companies like Anthropic and OpenAI. It's almost like it's effectively going towards the public market because those should be public companies. So it so if you don't have the right back, it's actually quite difficult. And just to give you an idea, back in, I would say, the average marker to raise a great Series A, for example, was to reach somewhere like 800K or a million in ARR. You could raise a seed round at, call it 10 to $12 million, and then you could get to a million in ARR, and you can raise a Series A at $40 million. And that was very standard at Silicon Valley those days. Fast forward today, some people are raising $2-3 million seed rounds. The average price out of Y Combinator, for example, is now 30x Series A. You have to raise that on a $70 million valuation. And I read a stat online recently that said 1 in 5 to 1 in 7 companies actually reach that Series A mark from the seed round. And the expectation is that instead of reaching 800K in revenue, you're now going to be reaching 3 million in revenue within the first year or two. It's quite a hard area to hit. And inevitably, you have a lot of startups that back in the day would have had great metrics. They would have went from 500K to those companies are really struggling. So there's a really big bifurcation in venture capital right now. Many funds are doing one of two things. If you're a name brand fund that was traditionally funding Series A's and Series B's, and you now see you need to put in $1 billion into some of these foundational labs, and that there's a lot of both management fees and great companies at the later stage that are remaining private longer. A lot of them are raising larger funds. So you'll see that companies like Sequoia, Lightspeed, Greylock, they've all gone out and raised multi-billion-dollar funds. And now they still do early stage. But if you think about how large their funds are, the majority of that capital will be deployed at a later stage. So they're shifting later. On the other end of the spectrum, there's now an additional trend where a lot of people are starting these small micro funds at the earlier stage because there's now so many more entrepreneurs than there ever were, and it's easier to start a fund than it ever was. Especially in kind of 2021 to 2023, there were a lot of early stage micro funds that particularly focus on pre-seed and seed that were started during that time. And so if you think about how that affects like the venture capital or the lifespan of a startup, seed stage rounds now tend to be party rounds. There tends to be a lot more investors, a lot of super angels. People might go through different types of accelerator programs like A16Z Speedrun, HF0, YC, etc. And that's at the seed round. The Series A is becoming increasingly difficult, like I mentioned, to raise a Series A and a good Series A. And then once you hit kind of the Series B, C, D timeframe, there's now more later stage funds than ever who now can write multi-$100 million checks into these companies. So those rounds tend to get really competitive. And as a result, companies are staying private longer than ever because a lot of the times they can actually get a higher valuation on the private markets than the public markets. Traditionally, at every single round, about half of the companies would survive to the next round, to the next round, to the next round. And now, especially between the seed and the Series A, I would say the survival rate is somewhere between a third to a sixth instead of a half.
Wow, that's definitely a lot to consider. What's the difference between you investing personally versus with a fund?
Ah, now that I run my own solo fund, it's actually pretty similar in some respect. But let me give you an idea of how a venture capital firm decides to fund a company, and then I can give you an idea of how a personal angel investor decides to fund a company. So when I'm part of a VC firm, my firm usually has a set of limited partners, or maybe it's one limited partner. And we usually have a particular strategy that we are dedicated to. So in the case of my solo fund that I mentioned, I'm dedicated towards funding companies at that inflection stage between $1 and $10 million in revenue. I'm dedicated in putting in $500K to $1 million checks, which I promised. And I'm looking for specific areas within AI and within some advanced industries as well to fund. And so when I think about that, those are the types of companies that I specifically go after. In addition to all that, when I was part of a larger fund, when we met an entrepreneur, we'd go through largely a process which most venture capital firms go through the same process. I even do so myself currently. But at the end of the process, you would go through a committee and you would do voting and you would make sure that it fits kind of the criteria of the firm in order to invest. Counterbalance that with someone who's investing personally, you might know a entrepreneur for 10 years who's starting a company earlier, who's maybe doesn't even have a deck yet, but you've known them personally for 10 years and you think that's a good idea. So you might invest there. Maybe you have an opportunity to buy some secondaries for someone at a discounted price. You might occasionally do that. So there's a lot of more unique scenarios that you can invest against. For example, in my previous firm, we said we would invest in seed Series B companies. So when a company approached us and was looking for secondary at multi-billion-dollar valuation, we didn't even consider it. On the other hand, I had a chance to do that earlier last year for a great company that was worth over $10 billion, and I thought their metrics were really good, and I decided to put in some of my own personal capital. At the same time, there might be some categories which you can and cannot invest in as part of a firm. So maybe, for example, my current firm is focused largely on enterprise, so B2B or infrastructure. So if there was a company in the consumer space, I wouldn't invest out of my fund quite as often as I would out of my personal account. So I think those are some of the differences, especially if you compare like some angel investors. I would say generally they can also move a lot faster than a large fund. And because you're putting in less capital, you can actually do a lot of different strategies and get into a lot of different companies. I'll give you another example. Back when I was working at F Prime or Trinity, we always had to lead deals. And so we had to get 15% ownership of a company or at a minimum 10% ownership of a company. And one day an entrepreneur came in. He actually used to run a company he ran a company called We, which is an online grocery delivery service, which my wife and I literally use every single week. And we knew it was going to take off. It was a very good price. They had great revenue, great metrics. And the entrepreneur came to me and was like, hey, I have $2 million of this round left and it's worth over 100 million. Do you want to invest? And I couldn't invest because it didn't fit our investment thesis. But had I had the ability to invest personally, I would have clearly put in money myself. So that was an example where something in the fund made it so that it was not quite a perfect fit for something I could have invested in personally.
From your experience as a founder, what was the hardest moment and how did you cope with it?
I think there were a lot of really hard moments. as an entrepreneur, you go through a lot of ups and downs as an entrepreneur. And every time something goes wrong, you think about it a lot. Every time something goes right, you think about it a lot. Trying to think about some tough moments for us. This was when I was running product and engineering at the company that acquired us, but I distinctly remember there were several moments where we had an idea of where our revenue would come from. And our CEO especially had a really strong hypothesis that this is where we need to make money. And when we tested that hypothesis, it didn't work. And so we had to pivot several times. And every time we pivoted, it felt like, hey, this could be the last pivot that the company could ultimately have. So I think when you have an idea and something is beginning to work and it seems really good, and then all of a sudden something goes wrong and you need to completely change the revenue model or the product, that's ultimately really tough to cope with, I believe.
What have you gotten much better at recognizing after years of investing?
I think after years of investing, you just get to see a lot of reps of different things. So I think like after a certain number of reps, you start to get better at one thing, and then after a number of reps, you start to get better at another thing, etc. So let me give you some examples. I think on your first year or two of venture, you start to recognize, hey, this is what a great entrepreneur looks like. Like you see examples of some companies that are worth billions of dollars. You get to talk to some of the top entrepreneurs out there. You get to recognize that. After about 3 to 5 years, you start to recognize, hey, there's some patterns in different types of companies, or I might have seen a previous version of this company or a version of that company from a few years ago. And you start to see patterns of like what types of sales channels works, what are some product things that are really important, are there any past examples in this industry, can you draw a parallel between one startup and another and maybe connect the entrepreneurs so that they can learn different things from each other. And I think when you're in venture for 5 to 10 years now, I've been in it long enough where you start to recognize a lot of the faces, a lot of the people who are partners or general partners now of firms all started in venture at the same time as me. So you start to know, hey, this person is looking for this person's looking for this. This is where this person might be a little bit over biased. This is where this person might be a little under biased, etc. So I think those are the things that are tough to pick up with 6 months of experience. The technology is changing, but a lot of these patterns will repeat themselves. And that's part of why I think it's so important to not only have a bunch of people who are very young and hungry at a firm, but also to have people who have been in venture for a number of years, because they've seen the cycles, they can see which companies can actually have large outcomes. Like most companies don't exit for 3 to 7 years. So unless you've been in venture for that long, you can't recognize what the buying patterns of certain firms are or the certain companies are.
Great. Thank you so much for sharing your time and experience. A lot that you covered, both on the investing side, your own personal career journey as a founder, to venture capital and how you view the AI market today. Thank you so much, John, for sharing your experience. Thank you for listening to Brave. If you enjoyed this episode, please share the podcast with your friends and colleagues. We would also appreciate you leaving a rating or review. Head over to www.bravesea.com for member content, resources, and community. Stay well and stay brave.